Hi, everybody. Mike White here. Welcome to this week's vlog post. This week, I just want to deal with creating a positive strategy as opposed to dealing with all the rate volatility and things that we've discussed in the past and the conversations we've already had. But again, in focusing on the positive, let's focus on some things that we can be doing that generate positive value to our clients and our referral partners, and at least put ourselves in a position where we're offering an option to some of our clients and potentially some referral partners that set us apart from our competition. Now, I want to preface this by this strategy will only work for those who are in markets with home prices that are, seven figures or so. So I know that leaves out a lot of people, but it also demonstrates a point that I've made repeatedly through the past about, unintended consequences of sharing certain information that everybody else in the industry is going to share at the same time. And for some, act as if they've created something. So this is about establishing yourself as a local professional and dealing with market awareness and some things you can do, again, just to create that little bit of differentiation that sets you apart. And I call it mortgage rate arbitrage. And it's a little bit of fun. And before we get going too far, I understand everybody doesn't have the same rates. Everybody doesn't have same access to the same programs. Everybody doesn't have, the ability to do certain loans and whatever. So the numbers that I've pulled, I simply went into Google search. I pulled up a generic mortgage rate analyst, which basically just pulled average rates up. When you fill in the boxes, it plugs in a rate. I've tried to manage things as best possible, knowing full well that in this market, there's not a lot of room on, at par or beyond. And weighing out points and all this other stuff. I've tried to keep things as realistic as possible. But again, the only way for you to know how it applies to you is for you to actually do the work based upon your availability and who your investors are. So I say that, understand that that's the premise by which I went, and I just went into a generic rate guide and plugged in some numbers and generated payments just because I wanted you to see, what it looks like. And you can do this yourself. And it might even be you can show your clients and other people that it doesn't even have to be your particular rates. You can use generic stuff for demonstration purposes. So then that's what this is. It's just a demonstration about looking at things in a slightly different way that can set you apart. And I say this because just a short time ago, just about every originator in the country was posting about how their new conforming loan limit was going up to $715,000. I am connected to lots of loan officers on social media. Some have me on, email and whatever, and I literally saw hundreds and hundreds and hundreds of the same. Hey, looky here, ABC, EFG mortgage company or bank has now increased its conforming loan limit. And saw that plenty of times. And in fact, it's the exact type of messaging, social media broadcasts, and emails that I tell my clients not to do. Because again, it doesn't separate you from anybody else in your market when everybody on the planet is rushing to do the same thing. And so while it certainly doesn't differentiate you from your clients or from other competition, it also may put you in a spot that it actually makes you look the same as every other originator in the country, if not downright stupid, for thinking you've got something that everybody else has. So what I wanted to do with this is put something simple out there and post something and not represent, something as special that's certainly not special. Because the more you run around yelling and screaming that you've got something special that everybody else has, it kind of reminds me of the story of Chicken Little. You scream the sky is falling long enough, people end up just ignoring you because they realize there's nothing special about what you're saying. And in the off chance that you do have something special to say, no, everybody's ignoring you. Nobody's paying attention. So you don't ever want to be in a position where your clients and your referral partners and the market in general is seeing you as somebody that they're just going to ignore because you're just saying stuff that everybody else says, and that doesn't matter. So my bigger point about mortgage rate arbitrage and that new loan limit, let's play a little game here and realize that higher loan limit could very well be costing your clients money. Think about that for a second. I just said most people think that the conforming loan limit goes higher. It's a benefit to their clients because now they can borrow more money on the conforming loan rate. And that would be great if it weren't for a fact that right now, jumbo loan rates are significantly lower than conforming loan rates. So anybody taking a $700,000 loan in today's market under the new loan limits is actually paying a substantially higher price for that same money because of where the jumbo rates are. So when I talk about this, and again, you can plug in your own rates off of your own rate sheet. And again, we vary from investor to investor, and I just took it off a generic calculator. But here's what I found. And again, do your own math. And again, this was based upon rates that I pulled up on the 28th of September in the morning when I was starting to prepare this information. And so, again, it may change, but again, it doesn't change significantly based upon where your market is. But let's look at this. And so I put in a $700,000 loan at 7.5% on a 30-year fixed, and the payment came out to $4,895. Okay. Then I went to an $815,000 jumbo loan and at 5.9% for 30 years, and the payment came out to $4,834. So what does that mean? Well, it means that your client for the same monthly payment could get $115,000 absolutely free. In fact, it's $61 a month less based upon this math. Think about that. Somebody's buying a $1.2 million house and they were going to get a $700,000 loan just because that's what they were going to do, because they were going to stretch out. Well, we'll take a number and say, okay, we'll put the rest down and we'll take a $700,000 loan because that's at the top end of the conforming market. Well, they could have taken an $815,000 loan, kept $115,000 in their pocket, and spent $61 a month less. So imagine the conversations you can have with accountants and financial planners, or even those agents who are working the higher end of your market. And again, I'm sure that not everybody has a steady stream of seven-figure properties coming past them, and many people do not have, the opportunity to do $700,000 or $800,000 loans. But based upon the sheer number of loan officers that publish to the entire world extolling the virtues of a higher conforming loan limit, without realizing that under the old loan limit, that $700,000 loan would have been a hell of a lot cheaper than it now is being a conforming loan. So imagine the conversations you can have with financial planners, and again, accountants and those real estate professionals out there, those borrowers in that end, okay, that little bit of differentiation may be all it takes to establish a relationship or to grab that client. And when we're talking $700,000 or $800,000 loans or more, it doesn't take many of those each month to really make your month look, really sharp and help you out. And it may just be that point of differentiation in your marketplace that sets you apart from your competition. As always, questions or comments at mike@imtcoaching.com. Have yourself a great week. Take care.